The coronavirus is officially over. That's what you would think if financial markets were your only metric for measuring a recovery. The benchmark U.S. stock and bond indices now trade higher than they were trading a year ago. They've seemingly brushed off any fears of a post-pandemic slump. How is this even possible? I'm Taha Aras, and I'll tell you how, in brief. 36 million Americans have lost their jobs in the last 2 months. That means nearly half of all U.S. households that make under $40,000 a year are now collecting unemployment. While the House of Representatives just passed an extra $3 trillion stimulus package, the Senate has signaled it will block its passage. Millions are unable to pay their rent, and businesses are filing for bankruptcy right and left. So why is the stock market up? The answer is something you've probably heard a lot of recently: quantitative easing. So what is quantitative easing? Quantitative easing is just a fancy way of saying the central bank of a country is making money out of thin air and spending it. Imagine you're playing a game of Monopoly and all the players agree to give everyone else an extra $1,500 in the middle of the game. You've just injected money into the game's money supply. The Federal Reserve, European Central Bank, and Bank of Japan have been quantitative easing frequently since the Great Recession in 2008. Now, central banks have really increased the pace, buying everything in sight. The Fed's purchases by far dwarf all other central banks doing this, and it's spent trillions in the last 2 months. So what exactly is it doing? The Fed forms a corporation that it owns and controls. It then lends this company trillions of dollars at nearly 0% interest. How does it do that? Someone literally sits down at a computer and enters a number with a lot of zeros in that newly formed company's bank account at the Fed. That's it. It's no different than photocopying Monopoly money and passing it out. But the Fed doesn't just pass out the money to everyone. It buys U.S. government bonds directly and indirectly. This allows people that want to sell them without losing money a chance to liquidate these assets. It also means these assets don't fall in price, which means the government pays very little in interest when it borrows to finance. The Fed also buys investment-grade corporate bonds and now even some toxic junk bonds. It buys most of these indirectly, but the point is, people that have held on to these assets have now cashed out, allowing them to use this newly freed up cash on whatever they want. This includes stocks and other bonds. The Fed has sent the message, "We'll buy whatever you're selling." This has kept prices high and Wall Street optimistic that the Fed won't let anything happen to the stock and bond markets. And so far it hasn't. Obviously, the question is, how much quantitative easing can be done without adversely affecting the broader economy? Many share these concerns. But to quote Federal Reserve Chairman Jay Powell, this is not the time to act on those concerns. In other words, don't worry about it. We'll figure it out after the pandemic is past. For now, Wall Street has no choice but to take the Fed's advice and its money.